top-down analysis can be simplified, and this is exactly what I'm trying to do in this particular video. I'll be taking you through the easiest and the simplest process to do your top-down analysis. You see, we are navigating through different time frames on the same chart, but then different expression of that chart. I have a sketch here. I want you to start looking at this from the weekly time frame. This is usually what you're going to see. From the weekly, you're going to see an overall order flow. We've talked about that, where price started from, and that is the overall direction of the price. And then if you jump to the daily time frame, the structure is going to be a bit noisy. You're going to see the structure a bit different from the weekly time frame structure. That is why you see this one, we just had a shifting structure, break of structure, and another break of structure. But then when you come to the daily time frame, you're going to see that on this single movement, we have two swings on the daily, right? This is the weekly swing, and then on the daily, we have two swings. So if you are doing your market structure, because of this kind of things, you're definitely going to have confusion if you don't know what I'm about to tell you in this particular video. Now take a look at this. If you are marking this place as a break of structure on the daily time frame, and here on the weekly there is no break of structure, that means you're going to get confused. So this is what you should do. If you are marking structure across time frames, strictly use your structure on a particular time frame differently. Let's say you've marked this as a market structure shift on the weekly. You're not going to use the same place on the daily. You should do for the daily differently. That is refinement. You see that? So if you're doing it on the weekly, don't use what you have on the weekly on the daily. You're going to use some key levels, but then not the structure. I hope this clears your doubt, right? Now, let's go to the next thing. If you're looking at this price action, while somebody is looking at this retracement as a retracement or maybe as a downward, somebody is looking at it as a bullish movement because we had a shifted market structure here, you see? So when you hear people give you their biases for a day, I am going to show you how to get bias. There's something I call the current bias. I'm going to make a video under the same chapter on current bias. But then while somebody is looking at this as a shifting structure, of course, and the guy is telling you that I am bullish, you are looking at it from the weekly perspective, and that is a bearish movement entirely, but it's just a retracement. This guy is just a retracement to this area. The guy is looking at this area as a bullish movement, and you're looking at it as a retracement. It doesn't make you right or make him wrong. It is simply different perspective of time frame and the market structure delineation. So when we talk about a direction or bias, we're simply looking at the current direction of the market and the time frame under concern. So we look at this and we call that a break of structure, while the weekly is having something different. So the same thing goes to the 4-hour time frame. The 4-hour time frame will have a more choppy price action because it is on the lower time frame. So you're going to have a lot of swing points on the 4-hour. Why? Because it is the lowest time frame and the candlesticks there are more than the ones you have on the weekly, you see. So your structure here is going to be completely different from what you have or even on the daily, you see. If you have the weekly structure, you're going to have the daily structure and the 4-hour structure. I'm going to go through my chart and begin to show you how these things work so you can see how to simplify your top-down analysis process. So this is a chart I want us to look at. Now, when you're doing top-down analysis, please do not factor out too much data. You see, you have a lot of candlesticks on the weekly. If I take my cursor here and look at the time, this is January 2018. I don't need that. I do not need that. What I need is the current price levels that I have, more especially this area where you have a lot of focus on this area. Let's call this area, this is our focus. Now, if you're looking at that, you can even look at this and say, oh, we have this massive range from this low to this high. Price went from this sell side liquidity to this buy side liquidity. And I'm dealing with whatever I have within this massive range. But then this is not even the target. What I am going to do with this is just to simply define the overall, that is the bigger picture of your buy side and sell side liquidity. I can call this sell side liquidity, and this becomes my buy side liquidity. I hope I wouldn't take so much time explaining this because I have other videos to show you on the same topic. So that is the buy side liquidity. This can later be considered when price is taking a swing target, but then you may never get to use this target immediately. So what you have here is the market structure delineation. Here, at least do 3 to 4 market structure delineations. So starting from here, we have price at a break of structure, or that is a shifting structure rather, to the bearish side. Of course, if you don't know that it's a shifting structure, you need to go back to the structure chapter, right? We had this movement, this entire movement, no retracement, and another push. Then what do we have? We have price coming, and what do we have? This is the most trickiest part of it. Now look at this. Price came back and used this area for a push down. But then while it was pushing, we had a sweep of liquidity above this guy, which is a very interesting one. You have to be careful while you're doing this because it's going to inform every decision you're going to make. And what do you see? We had price creating massive push below here. Now, the reason why I am using this is because I've seen a breaker block formation. You can use this place if you don't want to confuse yourself, all right? But then I'm seeing a breaker block formation. Remember your breaker block, the last sell candle here. So this is going to be very useful for me when I come to decide whether I'm going to take a trade or not, because I am going to be using this range, assuming I am taking a trade on an active price action, assuming this is the trade I want to take. That is what I'm going to see. That is a break of structure in the bearish direction. Do you see that? We had a massive shift in structure. Price came all the way. You see, this is a massive push down, and boom, we have a retracement, right? These two candles are enough to be a retracement, not this one candle, because if you see, this one candle has done massive move, even more than this. So boom, this entire movement is just one move from here to here. All right, so do not worry yourself on that one. The weekly time frame, usually the structure is just get the major swing points. You don't need to get the exact and confuse yourself with the structure. So what I have here is basically the weekly time frame delineation. I know that price is bearish at least for some time because each of these candles takes a week to form. So you can see how much time it will take you, right? Now, what you should do is that after knowing that price is bearish, that is the only thing you need to know about the weekly, right? Now you can jump to the daily time frame. Now, if you see the daily time frame, you will see that we have a more deeper price movement on the daily time frame. If we are refining our structure, we're going to do something completely different. I hope you're seeing it. Now, I want you to do something. Now that you have seen that we have price going back up to the daily time frame premium area, I didn't mention that we need your discount and premium well delineated from the range you're dealing with. You have a range here, the high here and the low here. You see that? That is what you need to define. You have the premium and the discount. This is the premium and the discount. So whatever it is you're going to do, you're going to be considering what is on the premium side of price, and that's exactly what this bearish breaker block is all about, right? Let me see if I can get this correct. The borderline, take it down, and the background, let me have some color on the background. Okay, perfect. So that is a bearish breaker. That is what you're going to use. And now price is going back up there. On the daily time frame, that is exactly what you're going to see. Price has been going up. Now, this is it. While you're looking at the weekly time frame as a bearish market, as a what? As a bearish market. Somebody seated on the daily time frame has been buying since from this area, has been going bullish. You see that? Has been going bullish. So while you are looking at a bearish weekly, it doesn't make this guy wrong. It is simply opportunities he's taking. This one, he's taking an entire time to trade this retracement as a bullish movement. It doesn't make him wrong. You see that? You are simply going to be careful with when price finally reaches the weekly time frame objective. That is the bearish breaker block. I hope you're understanding. The bearish breaker block we marked, or it can be a fair value gap, that's an inefficiency or imbalance. If price is going back into that area, we should be careful. Now that price is going back there, we can ride on the wings of that. That's an entire week or even a month price action. So I don't care what stands on my way. So what I will do is that while price is retracing back up there, I will have an opportunity to ride on that. I may not see the shifting structure on the daily time frame, but I can use the 4-hour time frame to establish a shifting structure and start taking my trade in that direction. And here comes where the 4-hour comes in very handy, right? Now this is the 4-hour 4-hour time frame. Look at this. We have price coming down, coming down, coming down. It had a retracement. Remember I said if you are establishing a retracement, you need at least 3 candles. But then the swing level or the swing arm of that movement does not necessarily have to be up to 3 candles. So I can consider this as a shift in market structure bullish. I know somebody is trying to get confused now, but then do not get confused. Go and watch that video I did on structure. That is why I was able to reiterate on those things so you will not forget. Now this is it. We have marked this area for trade and price is going up, going up. What do we have left here? A bullish mitigation block, which is this guy, the last buy candle. If you don't know these things, you need to go back and learn them. A bullish mitigation block, the last buy candle. Please mark the entire candle and use it for your trade setup. So price shifted structure. Now I know that I have a lot of journey, a big journey to take into this area. That could be in thousands of pips, but then I'm catching it from this area. Notice what happened. All this while price is going down, there is no any location you can confidently say that there is a shifting structure. And that is what makes this shifting structure very important, right? So as price is going back up, it's definitely going to have impedance, especially this somewhere like this. Now, the only difference is that this guy is going up from a shifting structure. It is not just going up because it's retracing directly. So this movement is not going to confuse me because I have a shifting structure downward here. Now that price is going back up, notice something. Price went all the way up there, tap into this fair value gap. It started coming back and it shifted structure again. This shifting structure shouldn't confuse you because this is what we saw. Price had a retracement and it went up there massively, but then we are coming back into a very important institutional reference point that we left. You see, so price actually traded into this bullish mitigation block even after having a market structure shift. We have a market structure shift here and this is a break of structure also. You can call it a break of structure. So do everything correctly, right? That is a break of structure if you see that. And if you're getting confused from this, please watch this video again. Now, price is going to come back into my mitigation block, which is where I'm supposed to take trade. This becomes my area of interest. I want to counter trade into that premium area. We have sold all the way down here and this shifting structure is what I want to use. And this is it. This is where it becomes very handy for you to start taking trade. From the 4-hour, you can now drop down and monitor this point of interest or area of interest. Watch out for all the setups we talked about. Can jump to the 1-hour or the 15-minute time frame to find a shift in market structure that is befitting for trade entry. Price came all the way down there. It's tapping into this area or the 1-hour. I don't mostly use the 1-hour, but you can use it. If you're using the 1-hour, before you see a shifting structure, probably will be somewhere around here. Let's see the 15-minute. Maybe we're going to see a setup for us to take for a trade entry. Price is coming, tapping into this. We have this is news. Now, I don't want you to get confused with news. Whenever you see news, just let it be part of that. Don't get confused. You probably shouldn't be in trade by the time this news is coming out. I don't even know what news is that. But then we can see that price came. It has a massive push, a downward push, and it came back and created a shifting structure here. Do you see a shifting structure? That is the confirmation entry criteria we said we were going to use. That is the market structure shift. But then in all this, remember that you are actually counter trading what is happening from the higher time frame. You are counter trading a weekly original bias. So what do you have? You have a point of entry here. Do you see that? A point of entry. So this is your trade, guys. You're going long from here. Your stop loss is where? Below this low. That is your trade. You see that? If you're taking that, that is your trade, guys. You see, I'm not going to use some nice charts to give you perfect price action. I'm going to use some of the most choppy price action to show you that this can work at any time. You see, that is your entry for a trade. You have done top-down analysis. Now, alternatively, you can wait and be patient until when price finally retraces to the higher time frame objective, which is going to be found on the weekly time frame. That is the way to go with the trend. Now, while price is going back, you're going to experience some challenges. You're going to mark out some of those key areas on the daily time frame that could stand as an impediment for you. You see, that's an impedance for price, and we even have a bearish breaker. So look at this area. It's going to experience a sluggish price movement, and that should be reasons why you see how price is reacting. You see how price is reacting, right? And because of the energy that the retracement is coming, this guy came all the way down there and it had another area to bounce back from, going back up. So your target should be in tranches while you're trading this back up there. You are a day trader, right? You're trading this guy up to this area. Now, the moment price trades into the premium area of the weekly time frame, you stop taking the buy. You be careful. You stop taking the buy from here. So guys, that's basically one of the ways to avoid getting into trouble. The moment price comes into the premium area of that bigger perspective, that's the weekly perspective, you avoid taking any trade and you start aligning yourself with the original buyers from the weekly. And you're going to usually see it price coming to the weekly time frame objective, that is a bearish breaker, and from there you will see price reacting from there to the bearish direction, and you can join the movement from that area, and now you have the original buyers. You're following the buyers of the smart money from there. So taking trade using the original buyers becomes easier. Taking it all the way to this area, you can follow it on the lower time frame as price goes in that direction, because you know now that you have the weekly on the bearish side, the daily on the bearish side, and most likely the 4-hour time frame will be on the bearish side. I don't want to spend so much time explaining everything on just one video. I'm going to go to the next video and show you more examples, and then we're going to see how we can literally use this for ourselves to take trades. So let's quickly go to the next video.